So to answer your question, yes, Chinese are buying gold. Okay, but a lot of people ask me, hey, Eric, is there FOMO gold buying in China? They see pictures on the internet, they see videos of Chinese buying gold, right? And they ask me this question. I tell you, Gary, there's no FOMO. There's no FOMO. The Chinese are buying this gold at every price level. Every price level since $1,600 US.
Welcome back to Metals and Miners. I'm its founder and its host, Gary Boehm. Today we have a wonderful discussion lined up, and we're fortunate to have with us ERIC YEUNG. ERIC owns and operates a company that contracts out manufacturing to Chinese factories on behalf of global retail companies and chains. He's been accumulating gold since 2009. He's located in Hong Kong. ERIC has been active on Twitter or X, analyzing and discussing the gold and silver markets since 2021. You could find him on X at KingKong9888. ERIC, thank you so much for joining us today.
Thank you, Gary. It's a pleasure, and thank you for having me on your show.
Well, let's begin with your analysis of the Fed and their decision to cut 50 basis points last week and what you see the impacts of that being.
Okay, so the Fed cutting 50 basis points, it surprised me because I thought they were going to cut 25. And I'm not alone because a lot of people thought they were going to cut either 25 or maybe no cut at all, right? But they did cut 50. So I think what's going to happen is, this liquidity cycle is going to continue. I'm talking about the liquidity easing cycle for at least 8 to 12 months. Because I think the Fed is going to cut until probably the end of 2025 minimal, right? Until when inflation actually catches up or shows up in the data, when they have to eventually maybe pause the interest rate cuts in 2025. I'm talking about Q3, Q4 2025.
So is that the primary impact that that you believe is coming is inflation?
I think the inflationary pressures right now, if you look at the Fed data, right, it's not really, even with the fastest rate hiking cycle in history, inflation is not really going back below 2%. And, I'm in manufacturing. I still see, even though China is in deflation, I still see potentially a inflationary push in the next 12 months. Now that the Fed is cutting again, right? So yeah, to answer your question, I think inflation is going to rear its ugly head again in 2025, according to the Fed's own data. That's what I think.
Well, Eric, in your examination, do you expect the rate cutting cycle to be long and deep, or really just more for 1 year and fairly shallow? What is your take on that?
I think these cycles, cutting and raising rates down the road, starting right now, is going to get shorter and shorter. So this one, I think, probably, by the end of 2025, they got to stop it. Because like what I just said, inflation is going to show up again in the data, and they have to start hinting that they're going to stop, and eventually they're going to stop it. That's it.
So inflation picks back up, and then you have this wall of maturing debt at the same time. How do they balance this between higher interest rates, which causes higher debt servicing costs, which causes issues with the budget or the tax revenue deficit here, versus the inflation that is being caused?
They're going to probably hold it in a really tight range, meaning let's say they cut 1.5% this time, right? I'm being generous. By 2025 Q4, So it takes it back down to 4% around. Am I correct? Around 4%. They probably going to keep it at that level, hold it, maybe take it back up another 50 basis points for the next hiking cycle, or maybe 75. So it's going to be a really tight range, and there's going to be these rate cutting and easing cycles are going to be really short. Maybe it's going to be a year and a half maximum down the road.
I guess.
So this is So they're squeezing the lemon. That's what I'm trying to tell you, right? That's the analogy, right? Like you ask me, how are they going to handle the deficit and the interest payments, right? For the deficit. That's how they're going to do it. They're going to keep it in a very tight range gyration, and they're going to squeeze. It's all about optics, right? They do that, and the market is going to react. Do you see what I'm saying?
I do. Does that tight range increase or stabilize volatility in the markets?
I think they think it's going to stabilize volatility, but in fact, volatility is going to blow up just because of how unstable the structure has become because of the over leveraging, right, in the system. So they're trying to, by doing these short, easing and tightening cycles, which is something I believe will start happening. They are trying to make it more stable, but in reality, I think the markets are going to overreact to whatever Fed decisions or indicators that they give to the market. Just like what we're seeing right now, Gary, right? We see that every day. They say something and then the market just react, bam. Drop a couple 100 points, gold reacts, everything reacts, right?
If the market has a chance to react naturally, then it may have, a violent move one way or another, but then you would assume that volatility would calm down. It would find its own equilibrium at some point. But if the Fed is manipulating, forcing it to stay in this range, you would think that volatility would spike because the market is not being allowed to find its own equilibrium.
That's exactly it, right? You see that in the bond market right now, in the U.S. Treasury market. You see these overreactions, right? Because of exactly what you just said, right? The Fed, whatever they're doing is artificial, but the U.S. Treasury market out there, right, is what in reality the market is expecting of long-term and short-term interest rates. So you're correct there. I agree.
Well, so what's your current view on the U.S. economy, the markets, where it is in the cycle, and such?
In my opinion, the U.S. market, the U.S. economy is already in recession. I mean, we see that in the data, right? We see that in the non-farm payrolls, in the employment numbers, etc., right? In terms of liquidity, I think we like I just said earlier, we are still at the last maybe 2 innings of the liquidity easing cycles. So that's what I see.
Okay. So, Eric, let's turn our focus to China and their economy. What stage is their economy in, and where is it headed next in your analysis?
China is actually in deflation right now, internally. Okay? So what I see happening in China is that they're trying to restructure their economy. Okay? So the cheap stuff that they used to make for the West, US, Europe, etc., right? Well, like the West is trying to move away from China for those products to let's say Southeast Asia, etc., right? So what China has done in the last couple of years, and they have been doing it very successfully, they have been moving up the value chain. They have been, getting into areas like EV, electrical vehicles, and stuff like solar power, infrastructure, etc., right? Those are traditionally markets where the West, mainly Europe, Germany, the US, Japan, excel, right? China is getting to be successful in these areas, taking market share away from the West. But on the flip side of the coin, you have smaller, medium-sized factories that are losing market share to Southeast Asia because China's cost has been going up in the last 10 years, right? Number one. Number two is you have Donald Trump, started that trade war with China and, telling all these, retail chains, all these buyers in the US and Europe to start shifting away from China to other countries. So all these, low-end guys, they are having trouble right now adapting. So that market is shrinking. So that's what I mean by the Chinese economy restructuring itself. On one hand, like I just said, the high-end stuff, they're picking up steam. On the other hand, the low-end stuff is they're losing ground on that. Okay, somebody have asked me, well, you have the BRICS. Aren't the BRICS countries buying that, that shovel or that plastic toy from China? Yes, they are, but not at the same price as the Western buyers. You see what I'm saying, Gary? Right?
Yes, I do.
Because the quality expectations are different from, BRICS countries versus the West, right? So the prices are different. Margins are different, right? So what you have right now, when I said, there's deflation in China, because the lower end manufacturing has been China's bread and butter in the past. So you have all these factories contracting, right? I mean, like my followers tell me every day, like the guys who live in China, they're saying, oh, I was just in China, I live in China, we see all these factories shutting down. They burned down the factory to, this is just some hearsay, right? Somebody told me, right? They burned down the factory to get insurance money, right? I mean, that's the low-end guys. Low-end guys, not the high-end BYD, EV manufacturers, right? So, yeah, there is deflation and there is restructuring going on, and it's going to take time for China to, move more away from low-end to the high-end stuff, up the value chain, and for these, traditional factories that work for the West to migrate to something else. That's going to take time. That's what I see. And it actually translates into the real estate market as well. You see, because like the biggest buyers of Chinese real estate are the small factory owners in China. They were making money for the last 20 years, right? And now they have to scale back. Well, they're not buying as much properties in China, even when prices already went down by 50%.
So these small factories that are at the low end of the value chain that are losing market share over to Southeast Asia, some of them are already closing. How much of an impact is this transition going to have on the overall economy, or is it an impact? Yes, but the overall Chinese economy can weather this storm and come out of it through this transition you're talking about in a more powerful way where they don't have as much low end.
Okay. So the low end guys, what they've been doing, they have been opening factories overseas. Some of them even open factories in Mexico, right? Okay. How do I know? Because I'm in the industry. I mean, these are people I know. So, but then, some of the money come back to China. Like where, because their families are in China, right? They're not immigrating to Mexico. I mean, they're running a factory in Mexico. They're running a factory in Vietnam, right? But they're still living, their families are still living in China. So a lot of that money are still going back to China, right? That's part of it, to answer your question. So that's how they contribute to the Chinese economy. And then, another thing that is happening is that some of these low-end guys, they are trying to climb the value chain themselves to make products that have higher value, right? For the West. So we see that happening, but that again takes time. So this transition right now is definitely a painful period for China, for sure. We can see that with the deflation that is happening, but I expect this to change or like transit, China to transit out of it within probably the next 3 or 4 years.
Interesting.
That's what I see. Yeah.
Yeah, interesting. So it sounds like it sounds like from what you're describing that the low end, which is being impacted the greatest over there, the low end manufacturing, they're actually, many of them, not all of them, but many of them are adapting already or maybe got out in front of this.
Yes.
By moving some of their operations to other countries.
Yes. And also, some of them are trying to manufacture for the domestic market in China. Because like what's happening in China also, the online shopping like Alibaba has really picked up steam in the last couple of years, right? And a lot of factories have sales direct from factory to consumer through Alibaba. Well, in China we call it Taobao, which is a division of Alibaba. Basically, B2C is the B2C portal. And so a lot of factories are directly selling to consumers through that. And that's another avenue of for these factories to transit out of just purely selling their products to the West.
So is the Chinese population currently a buyer of gold and silver? And if they are you expecting that to continue?
Yes. Well, let's talk about gold first, right? The China, China's retail gold mainly comes from the Shanghai Gold Exchange, right? A lot of it comes from the Shanghai Gold Exchange. And last year, in 2023, 1,687 tons of physical gold was withdrawn from the Shanghai Gold Exchange for the domestic market. Think about that.
Wow.
That's a lot, right? All the central banks combined in 2003 bought 1,000 tons of gold. Okay? China in itself, for their domestic market, and we're assuming, well, it's very likely to be mostly retail purchases, right? Like distributed and then funneled to retail, 1,687 metric tons in 2023. So to answer your question, yes, Chinese are buying gold. Okay, but a lot of people ask me, hey, Eric, is there FOMO gold buying in China? They see pictures on the internet, they see videos of Chinese buying gold, right? And they ask me this question. I tell you, Gary, there's no FOMO. There's no FOMO. The Chinese are buying this gold at every price level. Every price level. Since $1,600 to even now, just last weekend, $2,600 they buy. US dollars per troy ounce. They're still buying. And it's all packed, these gold markets, okay, with China.
Were they protecting against a possible deflationary event that was coming to China? Were they protecting against a trade war? What was their foresight, or what are they seeing that's driving them to be such large buyers of gold?
Some people, minority, may see that, but most people are just buying it as a habit. I gave you a chart there, right? And I knew this all along. The Chinese spend most of the money in real estate, traditionally. Over 50% of their net worth is in real estate. 50 to 60%, right? And then they spend something like 30 to 40% in yield-generating products, like bonds, stocks, whatever, right? Savings account in China, right? And they spend maybe 5 to 10% of their net worth to buy gold. And it's not to buy gold for the reasons that you just talked about. It's just out of habit, because they traditionally, as Chinese, we think of gold as an insurance policy. It's funny because Rick Ru talked about that, right? Insurance policy, but it's in our culture. It's in our culture, right? Gold is insurance policy. So you always spend around 5-10% of your net worth to buy gold, the smart ones, right? And then if, things blow up, things go wrong, right? You have 5-10% in gold. So it's not about, them fearing deflation or currency debasement per se, like a lot of Western experts are saying. They have been doing this all along, non-stop, at every price level. That's the scary part, right? They're buying gold as a habit right now. And it's 1,687 tons in 2023. Imagine what will happen when actual FOMO shows up in China for gold. And I'll tell you right now, right? I will tell you what will happen when FOMO actually happens in China for gold, okay? In 2011, in Hong Kong, Chinese were buying gold in Hong Kong because they couldn't even get product in China, right? But back then in Hong Kong, they had at the gold shops, gold jewelry shops, they have the gold jewelry displayed, but not for sale. You have to leave your name and phone number and a deposit, and they'll get back to you in 3 to 6 months with the gold. Okay, some shops don't even have anything for display. 2011, at that gold peak. Okay, that's FOMO right there. We're not there yet. Okay, if Chinese people are really FOMO gold right now, because they'll be all gone. There's not that much gold around.
The question I was going to ask you was, what impact on price and availability of the metal does a population the size of China have when they're buying gold like that?
It will be, I think, at the end of it, like let's say, I believe this cycle, gold bull market cycle, if you call it that, we're going to see several peaks. And we talked about this, me and you, Gary, and you agree, right? Several, because nothing goes up in a straight line, right? Okay. Every single time when we see like a FOMO peak in this cycle, we're going to see probably China dry up, news of China dry up in terms of physical gold. Nothing that people can buy because it's all gone. You see that news. Okay? That's what's going to happen. And then you'll see the gold price shooting up maybe $100 per day when that happens.
So one of the I don't know if it's a rumor or what, but one of the things that has floated around in the last 6 months or so is that the government in China has been instructing the population to purchase gold and silver. Is that something that's happening, or do they not even need to instruct because of what you've already said?
They don't need to instruct anybody. They're encouraging people. If you call it that, to buy gold and silver. The Chinese government knows that a population that has some physical gold and silver is a population that will not revolt. They want stability. Make sense?
Yeah, it's a great point.
That's what I see happening, right? Like a lot of Western experts, somehow they think China is in the same situation as 1948 when China had that hyperinflation. Okay? The Communist Party today is not the same Communist Party in 1948, 1949. Okay? It's not the same party that it was in 1975. We got to remember that. Okay, they were dirt poor back then. They have just been through 100 years of non-stop war. Okay? Right? With the Japanese. And then the First World War, Second World War, non-stop. And they were broke back then. Now they have a lot of money. So the background is different. The government's initiative is different. Mm-hmm. Right? The things they want is different. What I think is going to happen is what I think is happening is that the Chinese government has been encouraging people to buy physical gold in preparation for the new BRICS trade system, if you call it that. That is going to happen soon.
So
right?
perfect segue, Eric. I have some questions regarding the BRICS. So let's go there, okay? So the BRICS nations, they're trying to form this alternative financial union and system with gold being the centerpiece of it. Their central banks, they've been the world's largest buyers of gold over the last decade. How do you see them using gold moving forward? And will they continue to be big buyers of gold for the years to come? And will they be successful as a new financial union and system?
So I think I agree with Luke Groman. He was one of the guests on your show in the past. And he explained, and I agree with him, that gold is going to be used by the BRICS countries as a settlement or net settlement, reserve asset. It's happening already. Okay, so but we're going to see that in mainstream news coming up. What I mean by that, and Luke has explained this before, is that you have Russia, China, India, they all trade with each other, right? And in the case of India, and we talked about this just now, before we started recording, India is not particularly buddy with China. They have some skirmishes, right? Small skirmishes in different areas, right? So what's going to happen? None of these people, they like each other to the point where they can trust each other's currency completely. Once they finish trading with each other, right, using the local currencies, if they're not using US dollar, right, what are they going to do? They're going to immediately try to convert that into gold, right? So in my opinion, no matter what happens with the BRICS, it's going to be good for gold. If they successfully push through a currency, some people suggest it may be called the unit, right? With a 40% gold backing. That's great for gold because gold is inside that, right? 40%. If they're not successful, they still need to use gold as a replacement for U.S. treasuries, as a net settlement reserve asset, right?
Yeah. Because
nobody wants to keep, I put my Western expert hat on, right? Nobody wants to keep RMB. Nobody wants to keep the Indian, what's it called, peso? Indian peso? Or
rupee.
Indian rupee, and the ruble, right? Yeah. They want to keep it in physical gold. So that's my perspective on that.
It seems undeniable, Eric. It just doesn't seem like there's really nothing to alter what you just said. I want to point everyone over to our Substack. It's free. Go to metalsandminers.substack.com. We post free content on the consumer, economy, markets, artificial intelligence, individual metals and miners, and all the expert interviews that we conduct, just like this one. They're all up there. And when you subscribe, we want to give you a free gift. It's a report that we wrote. It's based on the important Ray Dalio foundational premise. It's titled, "If You Don't Own Gold, You Know Neither History Nor Economics." This free gift is a must-read for everyone on why we all should own gold. So head over to metalsandminers.substack.com, put in your email address to subscribe, and receive the free gift on us. Also, I'm positive that you've enjoyed the conversation with Eric as much as I have. Please let him know by hitting the like and subscribe button and leave a comment below the video.